Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Danny Ekuye.
And I'm Andrew Gagan. Look, I thought I'm all about positivity, Danny. So I thought, why not join you on a day when the market has gone gangbusters?
Absolutely. We are experiencing effectively, well, zoom to the moon rocket emojis and a melt up on the market. So let's get straight to it and have a look, and we can see that COB 200, Andrew, it has been on an absolute tear, hasn't it?
Yeah, I guess this began yesterday with that, what was perceived to be a fairly dovish hold by the RBA. And then, of course, we had that GDP print today, which was certainly much cooler than expected.
Absolutely. So the COB 200 up by around 25 3/4, and that's points, and almost 2%, 1.9%. And the ASX 200 looks like it's finishing up around 125 points, or about 1.8%. But we'll have to wait for those closing trades to come through on the ASX. Let's turn to the three themes of today and have a look at those. And I called it the GDP goner.
Where has it gone? Where has growth gone?
Where has growth gone? We've had 3 quarters now of a negative real GDP per capita. People are really hurting out there.
Well, anecdotally, you only have to sort of walk around the city to work out that's what's going on. People are feeling it now, aren't they? Given the rapid rise in interest rates, the cost of living, it is all starting to bite at the moment.
Absolutely, and I believe we're paying huge amounts more tax, and our income levels are back to where they were in 2015.
Well, yeah, household consumption, that's flat. Disposable income falling by 1.7% for the quarter, 5.6% over the year. I mean, it's a huge drop.
It is huge, yeah. It's not looking like a very ho-ho-ho Christmas.
Plus savings. Now completely eroded, aren't they? You know, all those COVID savings that we built up?
Gone.
Yeah.
Gone. Anyway, the market, as Andrew was saying, decided to go to the moon. Clearly now probably discounting, and we'll be discussing this probably more with our guest, the fact that we may not have another rate rise in February now, and those interest rates are starting to bite. So markets have decided that, well, the RBA is on hold and we're all back to bad news is good.
Well, not just maybe discounting the prospect of another rate hike, now
Cuts.
pricing in rate cuts for the first time.
Yeah, I know. Can you believe it? Higher for longer, remember that?
Yeah. Things move quickly, Danny.
They do in the world of finance. And it is coming up to that time of the year, the mea culpa, when that arrives in your inbox, that little letter from your fund manager or the expert to say, well, I got this part wrong and I got this part right, but as I like to say, Harry, hindsight's a fabulous thing.
Yeah, regrets, I've had a few.
Exactly. There we go. Now let's move on to some sectors, and the REITs were on fire today, and it's really not hard to explain why. As Andrew was just saying, potential for interest rate cuts, and Charter Hall, which really gets knocked around, it's quite volatile, was up by over 4%, and Mirvac and Stockland weren't too far behind.
Yeah, green on screen, healthcare included, of course. We've seen some strong gains there, among them the biggie. CSL making a positive move there. Sonic Healthcare also. What happened today? It was I'm just trying to think. Sonic, was it movement just as far as a buying? Is it looking to buy? Oh, look, now I've got you going, haven't I, Danny? Let's keep going while we sort of take a look at what...
Exactly.
There's so much news out today, I've
still
missed it.
Interesting to see that one up by over 3.8%. And let's also have a look at the consumer discretionary stocks, because they, of course, will be beneficiaries if we get a drop in interest rates. And Wesfarmers up by over 2%, and also Domino's and Harvey Norman as well, up by almost 3%. And I think we've got a second page, do we, on the consumer discretionaries? No, we go to metals and mining. And interesting, South 32 up by over 2%, and BHP up by 1.7%. Now, let's get to the top corporate stories of today, and shares in Endeavour were on the rise as the company says it expects to grow its hotels EBIT by more than 150 million over the next 5 years.
Yeah, Perpetual also on that list, launching a strategic review exploring potential separation of its corporate trust and its wealth management business. as it looks to drive value for its shareholders. Adding the review will also consider the benefits of a more focused asset management business.
Yeah, so some long-suffering shareholders will be very happy to see Perpetual was up by almost 6% today. And Rio Tinto in focus, they have their investor day and they're committing to replace their entire fossil fuel diesel consumption with renewable diesel at the Kennecott copper operation in Salt Lake City. And yeah, they're basically saying that fleet of 90 haul trucks and all heavy machinery will transition to that renewables fuel. And also Rio is targeting to a reduction in carbon emissions of 50% by 2030 and net zero by 2050. And their shares were up a point, almost 1% today.
Now, going in the wrong direction and then some, Evolution. Look, this was expected. It went into a trading halt yesterday, taking a dive after the company has raised equity to buy North Park's copper gold mine for up to $475 million US dollars. So taking a big dive there. Look, gold has been under pressure though over the last couple of days, given what we saw on Monday morning, where it all went
melt up
just a bit to those new records, but having come off considerably since then. So actually, later in the afternoon, we actually saw a turnaround in gold, I noticed too, with the likes of like Northern Star actually entered in positive territory.
Yeah. Well, if you think about it, if real rates continue to come down, then it does underpin gold. That was my tweet of the day in terms of the big picture, if you want to go and check it out. Now, the stock of the day was Evolution Mining, and we had guests Sean Cartwright from Anhadara Asset Management and Daniel Ortizi from Stock Doctor. Let's check in and see what they had to say.
It's had a lot of debt on the balance sheet. It's had issues with past acquisitions. That Red Lake acquisition in North America has been, really disastrous for them. Basically, if you look at the portfolio, the only real assets that are generating strong free cash flows are Ernest Henry and also Cow, but there's been significant capex and other bills with those assets as well. Obviously, when they acquired Ernest Henry, huge stamp duty and other taxes payable to Glencore. So I don't think the market really wanted to see another acquisition.
I think they overpaid for this asset. I don't think they needed another acquisition. They already had a fairly convoluted structure internally. $500 million is a lot to take in. I'm not surprised the market's given it a hiding today. I don't see any reason to remain invested if you are. There are much better gold producers and developers.
So yeah, I think it's actually the worst day in about a year and a half for Evolution there.
Yeah, absolutely.
Yeah.
And for a lot of people, it's a good place to jump on board with that stock if you don't have it, potentially.
Yeah, absolutely, given how far it's ridden down and how many people are bullish, more generally, obviously, with gold. So not a bad starting point.
Absolutely. Now, William Symes from Macro Capital joins us now. Will, was that Will?
Yeah, a bit of a change, isn't it?
Yeah, it is a bit of a change.
Well, unlike the market, you've taken a big cut.
It's cooler in here. It's a lot cooler. I'm not going to sweat as much. It's great.
We're getting ready for that El Nino summer. Anyway, let's get back to what's been going on. So those RBA minutes and the outlook, have I got the right notes there?
Yeah.
Weren't the minutes last week or something?
So obviously the rate yesterday kept things on hold as expected, so no real move in the market yesterday. Same as always, basically said that any further tightening will be contingent on data from here on out.
The data's not looking too good, is it?
Well, there's not a whole lot of data that can really turn them until the Q4 CPI print next year, I don't think.
Right.
So they've obviously got their meeting in early February, and I think their decision to hike or not will turn largely on what that Q4 print is. Obviously, we've had a good day on the markets today. And after yesterday's statement, the prospect of another hike in February fell from 33% down to 23%. So things are probably looking a little bit more positive on that front. That said, I think at the moment, one of the things that we're positioning for is a potential divergence between the Australian and US markets, driven by a difference in interest rates over the next year. Obviously, the Fed moved far faster and far more aggressively with a few 75 basis point hikes in order to curtail inflation, whilst the RBA in standard fashion has moved far more moderately. And so the situation that we're looking to prepare for at the moment is a situation whereby Australia potentially has one more hike early next year, and at the very least I think will be higher for longer than what we see over in the US, whilst the US probably heads into the next phase being cuts relatively early next year. The CME FedWatch tool at the moment is pricing in 2 cuts over in the US by June. So I think we're likely to see a bit of a disparity between performance domestically and over in the US.
So are you, you're not contemplating cuts here, because now the market is actually factoring that in, the prospect next year we may well get a cut. Does that factor into your investment strategy?
Absolutely, it's something that we're cognizant of, but I do think that, I mean, the Fed's paused now for a while. I think that the RBA will need to pause for the foreseeable future at the very least before moving into cuts. They'll obviously wait for the Q4 figure early next year, and then I think they'll want to see some sustained momentum in terms of inflation coming back to target before looking to implement cuts. So whilst it is possible we do get some maybe towards the end of next year, I think that we can realistically play the disparity in the two markets' performance over the next 6 to 9 months before potentially looking to get a bit more risk on domestically for when we look to cut rates.
I don't know. I think they're going to be cutting sooner. That's just my 2 bits worth. I mean, I just think we've just heard all the reasons why today. I mean, if people are back to 2015, I mean, they're just going to increasing anyway.
Well, let's wait. Exactly. I was just about to say, wait for the job cuts to come,
and then suddenly it'll be like rabbits in the head. Like really, we cannot spend now anything.
Yeah.
Well, I mean, we're not doing anything drastically. It's just been tweaking a little bit of our asset allocation, lightening some of our ASX equities exposure, increasing some of our fixed income exposure, and then also some of our US exposure.
So given that divergence then, Will, what's your, how are you placed, if you're going to pick a stock to take advantage of that?
Sure. Look, I think we've increased the model portfolio weighting to the US to approximately 30% at the moment. Initially just gone for a few different ETFs to get that diversified exposure rather than going stock specific yet, although we will look to probably get stock specific over the next few months. We've been in QUS for a while now, which is a diversified S&P 500 ETF, which is doing quite well at the moment. We've also recently picked up another recent ETF by Beta Shares, that the ticker code CFLO, that basically provides exposure to 200 of the highest cash flow companies globally. So get that diversified exposure that way. Companies that are well positioned, have money for further growth, buybacks, dividends, whatever it is, and just cut out of a few of our ASX equities that are already done quite well for us and just slight asset tweak at the moment.
Yeah, sure. And you also like Macquarie Hybrid, do you?
Yeah, I think the Macquarie Hybrids are an interesting one. We recently added some capital note exposure. The ticker code's MQGPF. And what that one does is that it pays quarterly distributions equal to the 3-month bank bill swap rate plus a 3.7% margin. So at the moment, the 3-month bank bill swap rate's about 4.2%. So the total yield's about 7.9%. One of the reasons we quite like that one is that it's not tied to the change in yields. It doesn't have that inverse correlation like a bond. And so if we do happen to have another hike next year, it's not going to be adversely impacted by that. Instead, you probably anticipate an appreciation as people look for that higher yield. And then what we'll look to probably do would be to rotate out of some of that fixed income into more bond instruments as we near cuts maybe towards the end of next year and look for that capital appreciation that way.
Fantastic, Will. Well, thank you so much for joining us
No worries.
today.
Good to be on.
Yeah.
A little different, but good to be on.
I know. Poor Dan, the mother, was in shock. He was like, what's going on here? Anyway, that was Will Symes from Macro Capital.
All right, well, let's take a look. With the market having now settled, let's get into those winners and losers. And we'll call lithium. Of course, lithium, Danny, has been under considerable pressure this year. The price has just, absolutely collapsed, and a lot of the stocks with it. Now, core perhaps among the worst of those, but today it's bounced considerably higher.
Absolutely, up 16%. And we've also got Polynovo up by almost 12%. Chalice Mining also up by 12%. And EVT, haven't seen that one for a while, up by about 9.6%. Let's have a look at some of the laggards, and we know.
Well, they're looking a bit lonely today, aren't they?
They
But
are
look,
looking-
we've already spoken about Evolution. We know what's going on there, particularly with the gold miner. Life 360 has come under pressure today. It has done well of late. So interesting to see.
I don't think there's any
where there's
particular
maybe a
new
bit of
news there.
profit taking, but would seem to be an odd day to do that. Also in the gold space from Elias.
Yep, and Paladin.
And Perseus,
And Perseus.
another goldie there
Yep.
as well, and some of the uranium miners feeling a bit of pressure today.
Yeah, but they have been on a tear. Let's have a look at some of the small cap leaders. And yeah, there we go. Core Lithium, 4D Memory up for 15%. And Carnaby Resource up about 8%, as is Coal. And let's have a look at some of the small cap laggards. There you go, Andrew.
Yeah, MedAdvisor down 13%. Premium. Premium. Yeah, that's taken a hit today off 10%. Some of the other ones on the move in the wrong direction. Beacon, Clearview Technology, and Synlait has also come under pressure today as well.
Clearview had been up, so a lot of trading going on at the moment. Now let's check in and see what is happening overnight, because we have that we've got the Bank of Canada policy decision, and I think they're meant to stay on hold. Yep. US data on mortgage applications, those ADP numbers.
Well, look, yeah, we've got a raft of jobs data coming out of the States this week. ADP overnight as we head into the non-farm payrolls at the end of the week.
Absolutely. And obviously that was one of the big movers, wasn't it, today, off the back of that jobless decrease in available jobs that was out overnight.
Less jobs available, that's what we're saying, isn't it?
Exactly. Yeah. It's been a long 3 days, dear oh me. Also, we've got the US trade balance and non-farm productivity, some earnings coming out. Campbell's Soup, apparently that's off about 35% this year. ChargePoint, Lovesac and Vera Bradley, never heard of those. Now, let's have a look at what is coming up in the day ahead tomorrow, Andrew.
Yep, luckily so we've got the trade balance out tomorrow. In fact, locally also new vehicle sales and overall international trade seen as moderating at the moment. And also China as well, and German industrial production, of course. Germany pretty much regarded as the sick man of Europe at the moment, isn't it?
Very much so, very much so. Also very exposed to China. Okay, well, that's pretty much it for today. But before we go, let's have a look on a final check on the market. And I have, there we go, the COB 200 looks like it closed up 1.9%. The ASX, however, a wee bit of profit taking coming in towards the end, but nevertheless closed up about 117 points, 7,178, or 1.65%. I wonder if that... I did go through the 200-day moving average at some point today, so that had Scotty tweeting that.
Yep.
Yeah.
Well, moving higher through the 200-day. Yeah, okay. Well,
which
that's
apparently
an important move, isn't it?
Apparently, yes, for those of you that follow that. But that's
well,
it for
feeds
today.
into the Santa rally theme, doesn't it? That we've seen in the States. So
Santa and his reindeers.
Well, and traditionally, historically at least in the markets, it's late December we're actually seeing those real positive moves.
I know, it was meant to consolidate a bit though, and it looks like the consolidation lasted about one day.
Don't speak too soon. There is tomorrow, Danny.
Keep my mouth shut. Anyway, you can catch up on all the great interviews and chats we've had today at ausbiz.com.au. Otherwise, I think, will you be bright and early tomorrow morning, Andrew?
No, I might do this again tomorrow. You never know.
There you go.
Alrighty.
Have a great evening.
See you tomorrow.